25% a year in dollar on something as safe as fixed deposit? That's the claim flooding NRI finance feeds right now. And the moment I see a number like that, I don't repeat it, I question it. So that's what this video is about. Not me telling you that you can actually make 25%, but the two of us actually finding out, is the number even real or is it a clickbait? If the number is real, how is it built and what are the catches nobody is talking about? And who is this genuinely for versus who should actually stay away from this? Those are the questions we will answer one by one. The opportunity underneath is real. RBI's June circular on FCNR rate is genuine, but so is the risk sitting right under the headline number. And I want you walking away knowing exactly where the line is. So what did RBI actually do? Everything sits on top of one move. On June 5th, RBI stepped in with a special swap facility, agreeing to absorb the entire currency hedge cost itself on any 3 to 5 year FCNR deposits raised between 8th June and 30th September of this year. It also exempted these deposits from certain reserve requirements, making them even cheaper for banks to hold. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. And this is Finicky, where I simplify money the same way I practice it. The moment it was announced, banks didn't wait even a single minute to pass it on. SBI rates its FCNR rates by 2.95% and HDFC pushed its rates up too. So something shifted overnight, and to see why it matters, you need to know what FCNR even is. FCNR is a foreign currency deposit. NRIs can actually open with Indian banks in dollar, pound or euros or any other foreign currency. You put in foreign currency and at maturity, you get back your principal plus interest in the same currency. No conversion into rupees anywhere, which means no rupee depreciation risk inside the deposit itself. Dollar goes in, dollar comes out, and that's how it works. So why did RBI need to step in? Because these deposits had gone quiet for years. Think about it. When a bank deploys your dollars in India, it has to hedge against currency fluctuation, and that hedging cost has historically run between 2 to 3.5% a year. That comes straight out of what the bank can actually pay you, which is why FCNR rates stuck at say around 3 to 4% range, and why inflows had actually collapsed in most recent years. Now that RBI is absorbing this cost, it opens up room for rates to jump. So today, these dollar deposits pay somewhere in the 6 to 7% range, tax-free in India and no rupee depreciation. On its own, already a strong number, but it's nowhere near 25%. So where's that bigger number coming from? This is the part most coverage gets wrong or skips entirely. The 25% comes from one thing: leverage. The idea is simple. You earn interest on the much bigger pool of money than you actually put in, but you only pay interest on the part you borrowed. That gap is where the extra return comes from. Let me put this in real. Picture an NRI with around $100,000 to put in FCNR. The big question is what it cost him to borrow. In the US, Australia, Canada, Singapore, most of the places NRIs actually borrow from, the best rate you are realistically getting today is around 5 to 6%. You might do a little better somewhere like a Singapore, but for most people, 5 to 6% is honestly the starting point. Let's look at two scenarios. First, no leverage. He puts in $100,000 into an FCNR deposit, paying say 7% and earns $7,000. Clean, tax-free in India, no rupee risk. For most NRIs, that's exactly where the story ends, and that's a perfectly fine place for it to end as well. Now say he uses leverage. He still puts in $100,000, but his bank lends him another $500,000 on top. And here's the number that decides everything. His overall borrowing rate is still say 6%, just 1 point below the 7% his deposit pays. That borrowing carries an SBLC cost too. I'm assuming he's negotiated it down hard so that 1% gap in his spread after keenly bargained SBLC is already baked in. The full 600,000 goes into the same FCNR deposit at 7%, pledged back to the lender through the SBLC, a standby letter of credit, which is just a promise that if he doesn't repay, the bank takes the deposit instead. Collateral basically, you understand that. Now the two sides. His 600,000 at 7% earns $42,000 a year. He pays interest only on the 500,000 he borrowed, which is at 6% overall cost is about $30,000. Now let's subtract that. 42,000 minus 30,000 leaves $12,000 in profit every year on top of the same 100,000 that was his to begin with. That's a 12% return in dollar terms. Side by side, the same $100,000 earned 7,000 without leverage and 12,000 with leverage. Your return on the same capital nearly doubled and nothing about the deposit actually changed. Your own capital was simply anchoring a pool 6 times its size while you carried the cost of only the borrowed part. That's the whole trick here. So where does that viral 25% comes from? For this, you would have to push the leverage up to 9 times your capital and somehow secure a spread close to 2%. Push both to the limits and yes, on a spreadsheet, the number touches 25%. But this is where I'll be straight with you and this is my own read, so weigh it for yourself. That 2% spread is the fantasy. Look at where lending rates actually sit today. Anywhere an NRI is realistically borrowing and getting even a 2% gap over your deposits is very, very hard. A 1% spread, like our example, is far closer to reality. So take a realistic 1% spread, keep leverage sensible at say 5 to 6 times, and in my honest opinion, you're looking at somewhere around 11 to 13% at the very most. I frankly don't see this going much beyond that in the real world, maybe another 1-2% here or there. Others may argue differently and that's fine, but this is my view. So the 25% isn't exactly a lie. The math works on paper, but it's theoretical, balanced on assumption that barely exists today. So now you understand how the number is built and where it really lands. Which brings us to the real question, should you actually do this? And before we get into that, I have a tiny ask while I have you. If this video is helping you, do hit the like button and subscribe. It genuinely keeps me going. And there's something I've been thinking about that I would love to have your honest feedback. You know how every NRI has those money questions that just never have a clean answer. Taxes, RNOR status, regulatory compliance, where to park your investments, property back home, estate planning, when to actually move back, and so on and so forth. I'm actually planning to start a podcast where I sit down with NRIs like you one-on-one and we actually talk through your real situation and figure out an answer together right here on the channel. Because the chances are, if it's actually nagging you, thousands of other NRIs are sitting with the exact same question. So tell me, do you think this is actually a good idea? Would you actually watch something like that? Drop a comment and I would genuinely want to know. And if you'd want to come on and be part of it yourself, there's a Google form in the description. Just tell me your story and my team will reach out to you. So back to the point, should you use this structure? It depends on what you can take on because the leverage multiplies risk as much as returns. What's attractive is real. Even at realistic 11 to 13% return, you are earning double-digit dollar return on something anchored by a fixed deposit, not equity, not anything market linked. The deposit is RBI backed in how the subsidy works and there's no rupee risk inside it. If you have capital and real appetite for structured leverage, the math is sound and the window is real, even if narrow. But now the costs that even pull this number down, start with the SBLC because our 12% assumed you bargained it down hard. Most people won't. A standby letter of credit can run upwards of 1% a year if you don't push on it, and on a spread that's already thin, a fat SBLC cost don't just trim your edge, it can actually wipe it out. So the 12% isn't a floor, it's close to a best case. Then add tax. Though India doesn't tax you, residents of UK, US and other countries tax you on interest and the take home shrinks again. And here's the bigger danger, the one that actually can cost you money. The whole structure is built on that spread and the spread isn't fixed by law, it's a market rate, so it can actually move. If your borrowing cost is floating rather than fixed and the rates rise during the life of the loan, the spread can shrink or flip. And if your floating rate climbs above your fixed deposit rate, you are now losing money on every leveraged dollar. At 5 to 10 times your capital, that adds up fast. That's not a small loss, it's a real hit to your principal. Here's also a practical layer. This depends on a bank actually willing to lend that much against an SBLC on terms that work for you, and regulatory comfort with this kind of leverage has actually shifted before. Math working on paper doesn't guarantee a cooperative bank on the other side. And if all this feels like too much, FCNR isn't only route India has opened recently. GIFT City has been expanding NRI access into equities and other instruments with separate market-linked tax treatment. I've done a separate video on this, it'll be linked somewhere here. Now, what's my take on this? The honest one-line version, the 6 to 7% FCNR rate is real, RBI backed, and one of the better risk-free dollar opportunities NRIs have seen in years. The 25% is theoretical in my mind. It needs a spread that barely exists today, and realistically, in my view, you're looking at low double digit at best before cost eat into even that. Leverage is never free. It just moves the risk from obvious to conditional. So who is this for? If you have dollars parked and genuine appetite for risk, you can explore it. But if you're in your late 40s or early 50s planning for retirement, and if your risk appetite is low, take the hiked FCNR rates only or with no or small leverage. Whichever camp you are in, leveraged or plain, don't move a dollar before running this checklist. First, the rates. I've put the full bank by bank breakdown on screen, so pause or take a screenshot of it now. Do you notice one pattern? The smaller banks are quietly winning this race. AU Small Finance Bank, Karur Vysya Bank, or the DCB sits right at the top around 7%, while the big names sit lower. SBI near 5.75%, HDFC in the 5 to 6% range, ICICI and Axis around 6%. And these numbers move weekly while the windows open. So treat the screen as a snapshot and check your bank's current rate before deciding. Second, safety, because not every bank carries the same level of it. Deposit in India are insured by the DICGC, but only up to 5 lakhs rupees per depositor per bank. That's in rupee terms, principal and interest combined. So for a dollar FCNR deposit, that's a tiny slice. So the large majority of your money still sits outside that safety net, riding on the bank's own strength. A smaller bank with an eye-catching rate is often pricing in its own higher risk. So therefore it gets attractive. So for a large amount, split it. PSU banks for safety, a larger private bank for rate and service, and check the bank's credit rating and NPA figures first. All free in their annual report, so it's easily available to you. Third, if you are leveraging, check the maximum your banks offer. SBI, for example, lets you borrow against your FCNR deposit depending on remaining tenure. Up to 3 years residual, a 10% margin lets you borrow up to 90%. More than 3 and up to 5 years, a 15% margin lets you borrow up to 85%. These limits vary, so verify the loan to value and margin requirements before proceeding. And fourth, FCNR isn't flexible. Exit before your tenure ends, and the bank typically cuts your rate by at least 1%, and if you have held it only for a brief period, you may earn zero interest at the end of it. And unfortunately, there's no partial withdrawal either, so you break the whole deposit. So don't treat it as your emergency fund. For money you might need it in the next 3 to 6 months, an NRI savings account, a liquid fund, or your overseas account is a better bet. For the FCNR portion, ladder it across maturities, one a year out, one 2 years later, or one 3 years later, so some money is always coming free without breaking everything at once. And if you hit a crunch mid-tenure, check whether your bank actually offers a loan against the deposit, often maybe up to 85 to 90% of its value, almost always better than breaking the FD and losing interest. I hope this gave you a clarity in terms of how this deposit works, but if you're still confused about anything, do drop your doubts in the comments. I would like to hear it from you. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with Finicky. Thank you for watching, and I'll see you in the next one.